Section 1.1 Understanding Dividend Payout Ratio. 1.1 Definition and Significance. The dividend payout ratio is a financial metric that indicates the proportion of a company's earnings that is distributed to shareholders in the form of dividends. It is calculated by dividing the total dividends paid by the company by its net income. Dividend payout ratio equals dividends paid/net income. The dividend payout ratio is important in assessing the sustainability of dividend payments because it provides insights into how much of a company's earnings are being used to pay dividends. Here's why it is significant. Dividend sustainability. The dividend payout ratio helps investors evaluate whether a company's dividend payments are sustainable over the long term. A high payout ratio indicates that a significant portion of the company's earnings is being paid out as dividends, leaving less retained earnings for reinvestment in the business. If the payout ratio is too high, it may raise concerns about the company's ability to maintain or grow dividend payments in the future. On the other hand, a lower payout ratio suggests that the company retains a larger portion of its earnings, which can be used for reinvestment or to support future dividend payments. Cash flow stability. The dividend payout ratio is an indicator of a company's ability to generate stable and consistent cash flows. A company with a low and stable dividend payout ratio may have a more predictable cash flow generation, reducing the risk of dividend cuts or interruptions. Conversely, a company with a high and fluctuating payout ratio may face challenges in sustaining dividend payments during periods of economic downturn or when its earnings are volatile. Growth opportunities. The dividend payout ratio also provides insights into a company's growth opportunities. A lower payout ratio suggests that the company retains a larger portion of its earnings, which can be reinvested in the business for future expansion, research and development, acquisitions, or debt reduction. A higher payout ratio, while providing current income to shareholders, may limit the company's ability to invest in growth initiatives. Industry and peer comparison. Comparing the dividend payout ratio of a company to its industry peers can provide valuable insights. Industries with stable and mature businesses, such as utilities or consumer staples, typically have higher payout ratios, as they generate consistent cash flows and prioritize regular dividend payments. Conversely, industries with higher growth potential, such as technology or biotech, may have lower payout ratios, as they prioritize reinvesting earnings for future growth. It's important to note that the dividend payout ratio should not be considered in isolation but in conjunction with other factors, such as the company's dividend history, financial health, future prospects, and industry dynamics. Additionally, different industries may have varying norms for payout ratios, and what is considered sustainable in one industry may be different in another. The dividend payout ratio is a key metric that helps determine the portion of earnings a company distributes as dividends to its shareholders. By calculating the dividend payout ratio, investors and analysts can assess how much of the company's earnings is allocated to dividend payments. Here's how the dividend payout ratio influences the portion of earnings distributed as dividends. High dividend payout ratio. A high dividend payout ratio indicates that a significant portion of the company's earnings is being paid out as dividends. This means that a larger proportion of earnings is distributed to shareholders, leaving less retained earnings for reinvestment in the business. Companies with high payout ratios typically have limited internal capital available for growth initiatives and may need to rely on external financing or debt to fund expansion plans. Consequently, a high payout ratio suggests that the company prioritizes rewarding shareholders with current income rather than retaining earnings for future growth. Low dividend payout ratio. A low dividend payout ratio signifies that a smaller portion of the company's earnings is allocated to dividend payments, leaving a larger proportion of earnings to be retained within the company. This suggests that the company retains a significant portion of its earnings for reinvestment in the business, such as research and development, capital expenditures, or acquisitions. A low payout ratio implies that the company emphasizes growth opportunities and is committed to utilizing retained earnings to fund expansion plans or increase shareholder value through capital appreciation. Impact on dividend stability. The dividend payout ratio also influences the stability of dividend payments. Companies with lower payout ratios tend to have more consistent dividend payments as they retain a larger portion of earnings, which can act as a buffer during economic downturns or challenging periods. In contrast, companies with higher payout ratios may be more vulnerable to economic volatility, as they have less flexibility to maintain or increase dividend payments if their earnings decline. High payout ratios may lead to more variable dividend payments or even dividend cuts during periods of financial stress. Investor preferences. The dividend payout ratio is an important consideration for income-oriented investors who rely on dividend income from their investments. Investors seeking regular and reliable dividend payments may favor companies with higher payout ratios as they provide a higher yield and consistent income stream. However, investors with a focus on long-term growth may prefer companies with lower payout ratios, as these companies have greater capacity to reinvest earnings for future expansion, potentially leading to higher capital appreciation. It's worth noting that the appropriate dividend payout ratio can vary depending on various factors, including industry dynamics, business cycle, growth prospects, and the company's financial health. Different industries and companies may have different norms and expectations for payout ratios. It's crucial to consider the company's overall financial strategy, future capital requirements, and the balance between rewarding shareholders with dividends and reinvesting in the business when assessing the dividend payout ratio.